Massive news just in from the US Treasury. The US government is about to borrow over $1 trillion over just the next 3 months alone and is planning to also suck $520 billion out of the financial system. This could trigger a dollar liquidity squeeze, sending Treasury yields spiking and even causing cracks in the financial system. The Treasury also just released the latest economic statement. See where they think the economy is and where it's headed. So the US government debt is going to be increasing by $1 trillion over just the next quarter alone. This would be $4 trillion if you annualize that out. But of course, we don't annualize that out. We look at the nuance. So why is this happening? So we can see here that for July to September, the Treasury expects to borrow $1 trillion in privately held marketable debt, assuming an end of September cash balance of $850 billion. So here's a sources and uses reconciliation table from the US Treasury. This goes through the financing need, how much of it'll be marketable debt, how much will be from other sources, the total, change in cash balance, and end of quarter cash balance. So what does that refer to? Remember, the US Treasury Department has what's called the Treasury General Account. It's the TGA for short. This is the checking account that the U.S. government uses to finance its spending needs. So here's the federal surplus or deficit. I've marked April with these yellow lines, and we can see that due to taxes or tax season, we see a huge spike in revenue for the government. This pushes their account into surplus. Well, we covered the last month's report where we saw a surplus, a surprise surplus being noted by the U.S. Treasury. Granted, it's very minor. But it is unusual for the Treasury to have a surplus outside of April. We can see there was a small one here in August of 2023 and a small one here in September of 2024. But in general, most months, the U.S. government runs a pretty large deficit. So here's the Treasury General Account and the DXY dollar index. So we mentioned this refilling of the TGA, this removal of $500 billion from the financial system. So the way that this is going to happen, and I will link to the Treasury to this as well as the table, but the way that this is going to happen is we are going to refill the TGA by up to $850 billion. Well, remember, this is basically the U.S. government's checking account that they use, just like a normal person would use a checking account to pay bills and finance their lifestyle. The TGA is very similar concept. So what I want to point out with the dollar here, remember the DXY compares the dollar strength as a currency to other currencies like the euro, mainly the euro. And what I want to point out is that when the TGA is being refilled or the balance is going up, what that actually means is dollars, that amount of dollars, is being removed from the global financial system. It is being removed from the system, removed from the global economy, and put in an account. It is when this white line it goes down that those dollars are being spent into the system and reintroduced into the global financial system. So what we can see with the dollar is that when the TGA is refilled, like we're planning to do, they're planning to take the TGA up to about $850 billion. When that happens, when they refill the TGA and basically, raise a bunch of cash to put in this account so that they have some buffer, when that happens, we see the dollar versus other fiat currencies generally appreciate. We can see it here as well when Janet Yellen ran the TGA down from about $1 trillion down to basically nothing here into the summer of 2023. She refilled the TGA, and look, we saw an appreciation of the dollar versus other currencies, versus other fiat currencies. And likewise, the opposite is true too. When the TGA is being spent down, that is one of many kind of contributing factors that we've seen cause weakness in the dollar. So if we are going to increase the TGA up to about $850 billion, that could put upward pressure on the dollar. Now, there are other factors, of course, influencing the dollar. The other way you can think about it is, the government is expecting to borrow $1 trillion And so, if the global markets start to fear fiscal stress or fiscal concerns, that could cause dollar weakness. We also know that Trump's kind of fiscal dominance approach of negative real rates and a ton of bill issuance, in my opinion, that would be very negative for the dollar as well. We have a lot of dollar headwinds for sure. This kind of rotation and capital repatriation, a general trend that's kind of around the margins as a headwind. There's a number of headwinds for the dollar, but this is part of the reason that we said that the dollar was likely to show a short-term bounce back in June. This is one of the reasons for that, is that we expected the TGA to be refilled, and generally speaking, this is a negative for dollar liquidity conditions. Put another way, the supply of dollars out in the global financial system is about to be coming down. Well, if the demand for dollars stays the same, you would expect the DXY to appreciate. You would expect the dollar to strengthen. So here's Fed net liquidity. This is a way to try to measure kind of the overall picture of liquidity conditions. And it includes the reverse repo, which we have here in yellow, as well as the TGA, which we were looking at in white, as well as the Fed balance sheet. Now, we know the Fed is reducing its balance sheet by about $95 billion per month. So that is called quantitative tightening. The Fed is reducing its balance sheet, letting assets that it has bought with newly printed bank reserves, letting those assets mature and basically roll off and not reinvesting any returned capital. So that is a reduction in bank reserves. And we'll take a look at that also in a second. But the red line measures the kind of overall dollar conditions. So that's measuring the balance sheet, whether the Fed is in QE or QT, right? Positive or negative for liquidity. And then you subtract out kind of draws on liquidity, like the RRP and the TGA. Because remember, what this is, the RRP, very similar to the TGA, it is sterilized dollars. When this hit almost $2 trillion, what that meant is that the Fed was sterilizing $2 trillion and encouraging it to not be put into the actual real economy by keeping it in this reverse repo operation. We've done repo and reverse repo videos, so I will link to those at the very end. But very, very simply, the TGA and the RRP, you can think of them kind of in the similar way, which is when the line is going up, when those balances are increasing, that is dollars that are basically being sterilized, kind of set aside and locked up. And so that has a negative effect on liquidity. Well, if the TGA alone is going to be drawn down by 800 or drawn up to $850 billion, that's about half a trillion in terms of dollars being removed from this Fed net liquidity. Now, we know the reverse repo has been drawn down significantly and is only at $150 billion, meaning there's only $150 billion in the RRP. And the Treasury is talking about refilling the TGA by $500 billion. So, yeah, there's somewhat of a buffer, but only $150 billion worth. And 400 billion is if the RRP just went to zero, you would still be left with $400 billion. So we could see that would take Fed net liquidity down significantly, and could cause again that supply of dollars to be removed from the system, the supply of dollars to be decreased. If demand stays constant, that could cause a dollar liquidity squeeze. Supply and demand, just like, say, a stock or just like the housing market. So here's bank reserves. We mentioned this. And then the reverse repo. What I wanted to mention or show this chart for is that the Fed did a study here. I will also link this as well. That as that for repo rates and overnight money markets, which we will take a look at next, Treasury repo rates have risen on average relative to the rate of the overnight reverse repurchase facility. They call it a facility. And what they're talking about here is that during QT, during quantitative tightening, as the Fed is reducing its security holdings, which increases the amount of treasuries held by private investors, the reduction in security holding also results in a reduction of Fed liabilities, which decreases the amount of Fed-provided liquidity. Both of these put upward pressure on repurchase or repo rates. And then this study was measuring the sensitivity of those repo rates to things like QT and the reverse repurchase agreement. But the point here is that as the reverse repo is drawn down, and basically down to almost nothing, and as the TGA is being refilled at the same exact moment that you have the Fed engaged in quantitative tightening, all of these are tightening conditions. Building up the TGA is tightening. The fact that the reverse repo is basically empty, only has 120 billion in it, 170 billion in it, and all of these conditions are tightening financial conditions, tightening dollar liquidity. So we looked at this. Here is that overnight money market fund or money market that we were looking at. We did a whole video on this, how the Fed sets the price of the dollar, which I will also link at the end here. But this basically talks about or shows the way that the Fed actually sets the Fed funds rate. And they do it via the discount window rate, the interest rate on reserve balances. The Fed still pays the banks to hold those bank reserves that we were looking at here in red. The Fed is paying interest. Well, that green line indicates the interest, which is 4.4. We have the effective federal funds rate, reverse repo, which we were looking at before. SOFR, this is the kind of more free market interest rate for overnight dollar liquidity. And what we had pointed out in the video on this overnight dollar market was we had seen the spike of the SOFR rate. Again, this is kind of on supply and demand of dollars or for overnight dollar loans. What is the interest rate that is being demanded by the market? If there is a huge demand for overnight dollar loans, but very little actual dollars, you see the SOFR rate in yellow spike. And we saw it break above the IORB, which was notable because that is quite rare unless liquidity conditions are strained. And then in purple, we have the SOFR minus the Fed funds. So this is taking the white line and the yellow line and finding the spread of those lines. As this line is going higher, what it represents is, again, a strain in dollar liquidity conditions. Now, this is also coming at a time, I mentioned headwinds for the dollar. This is also coming at a time where we have the federal deficit, the financing needs of the government at 40% of corporate profits as well as personal savings. So if you look at the deficit as a United States only issue, it's not, of course. We get financing from creditor nations like China, Japan, although less recently Europe. But if you look at it just as a U.S. story, what are the savings that American citizens can use to buy U.S. Treasuries, right? Personal savings, and then what are corporate profits? So you add the two of those together, and then you divide the federal deficit by that number. And what we see is that 40%. It's actually slightly higher. This data is lagged a bit. It's actually slightly higher, but 40%. The deficit represents almost half of the personal savings and corporate profits in America. So what that means is that in order to, if we were forced to finance the deficit on our own, it would take half of all of all of the American citizen savings and half of the annual corporate profits. This is a very, very stretched level. We can see going back that it really wasn't until post GFC that this number started to become so stretched. 10% is a much different story than say 40%. So again, the financing needs of the government are immense. And here is the deficit as a share of GDP. We know it's actually closer to 7%. Again, this is unheard of with an unemployment rate as low as it is. And we'll take a look at unemployment and inflation here. So here's another release from the Treasury released yesterday. This talks about their view on how the U.S. economy is doing. Basically, to summarize this, they think that the U.S. economy is in a strong position. They talk about the jobs market, payrolls being added to the U.S. labor market. They think that key drivers of inflation are moderating. And we'll take a look at the CPI and real GDP. They note that real GDP is going to rebound quite sharply, and that is kind of in the process of rebounding quite sharply. We talked about the labor market, very, very low headline unemployment rate. Now, if you look at U6, the U6 unemployment rate, which I think is a better way to measure unemployment, it is nearly double that headline 4.1. But they're talking about the labor market being relatively strong. They do notice or do note some tightening in the labor market. They talk about inflation here. Again, they think that inflation is headed down and in a good direction. We think it's going to reaccelerate. That's been our view for the past 2 months or so, and we'll show why. So they talk about all the positive disinflationary sorts of forces, and then they say risks to the outlook. So this is where they talk about the risks to the U.S. economy. They note that the percentage of surveyed economists that believe a recession is likely has decreased from 45% down to 33%. So a third of economists still forecast a recession. And they also measure or they mention uncertainty, policy uncertainty. They are kind of saying that that uncertainty will come down as things like the tax policy, right? We now have the bill. We know what the one big beautiful bill. We know what it says. There are these trade deals, right? Like the European deal that have been announced recently. So they think that as these deals are announced and kind of the tariff uncertainty starts to moderate, that'll be a benefit to the kind of overall uncertainty. They also mention household finances and say that in general, the American household is in excellent health. They talk about how financial assets like the U.S. stock market, home prices, they talk about how these are hitting all-time highs. And they even mention digital assets, so like Bitcoin. And so they indicate that this is, a benefit in the aggregate. I think it's interesting that they threw this word in there, in the aggregate, because again, we know that the bottom 80% of Americans are struggling mightily. I think that it's notable that they made the point in aggregate, right? We live in a K-shaped economy, and it's important to note when you talk about these things: is it everyone in America? Is it the average American, the median American? Those are two very different things, the average American versus the median American. We know the median American is in very, very bad shape. The average American, though, because of how well the rich are doing, the average American is doing quite well. So they mentioned that these financial assets are pumping and boosting household net worth. And then they also mentioned delinquency rates, and that these are starting to tick up, and we'll take a look at that next. So here's real GDP and headline CPI. So again, this is the headline consumer price index year over year change. Right now it's running at 2.4. We expect that over the next 12 months or so that this will probably start to reaccelerate. We also have been calling for real GDP to reaccelerate, and therefore, remember, nominal GDP is you add inflation to real GDP. Real is inflation adjusted, and then red is obviously inflation. So you add the two of those together, you get nominal GDP, and that's what we've been pretty bullish on for the past 3 months. We think that nominal GDP will reaccelerate. But we have seen moderation both in inflation, coming down from a peak of about 9% down to 2.4, and we've also had real GDP moderating as well. Now, we had seen this pop here into the late part of 2023. That has real GDP, real growth has been rolling over. We know the first quarter was not the best for real GDP growth, but we do expect that real GDP will probably start to pick up and curl back up, much like headline CPI. That is in line with what the U.S. Treasury believes as well. This is one of the reasons that inflation, we think that the risks to inflation are starting to emerge to the upside. So here we have the 5-year inflation rate. This is derived from TIPS, which are Treasury inflation protected securities, and then in white we have oil. In TIPS, or the expected inflation rate by the bond market, have generally been very tightly correlated to oil prices. Oil goes into everything. It is critical. If you're going to talk about inflation, you have to look at oil. It is a massive part of inflation. Part of the reason that we saw 9% CPI was that oil reached almost $120 per barrel due to supply shocks, but also domestic policy decisions by the last administration. What we can see is the 5-year inflation rate, the expected inflation rate by the bond market, has been heading sharply higher and is almost starting to break out, going all the way back to when inflation was 9% in 2022. We see here that during the summer of 2023, this 5-year inflation rate was higher than it is now. We are right now at 2.41. Back then, it was about 2.47. So we are not breaking out completely, but this has gone straight vertical. Basically over the past month or two. And oil prices, meanwhile, have kind of sort of been trending down. And if you go to the bottom here in the 5-year inflation rate, this has gone from 2.09 to 2.41. So about a 40 basis point move up in expected inflation. And during that time period, you have oil basically go straight sideways. So we're starting to get a divergence where the expected inflation rate is heading sharply higher. Meanwhile, oil prices are in this downtrend and over the past month or two are basically straight sideways. Here is that net worth. So here is household net worth on the white line, and then delinquency rates for all commercial bank loans, and then the delinquency rate for credit cards. We can see that overall, the delinquency rate for all loans is very low at 1.56%. We know a mortgage debt, for example, is quite strong because people were able to term out their debt at very low rates. But we see that, for example, with credit cards, floating rate debt, that the delinquency rate has picked up and is currently running about 3%. Now, if you go back all the way to the early 90s, you can see that this number is still relatively low, but they do note it as a risk to the U.S. economy. Now, we know that bottom 70, 80%, we know that their delinquency rates are much higher. We know that the K-shaped economy is real, but in the aggregate, what the Treasury is noting is that the average American is doing quite well because the top 1 to 10%, the rich, have so many financial assets, and those financial assets are just ripping higher to the upside. So we have home prices here in red and S&P 500 in white. We know the S&P is at all-time high, at least priced in dollars, and we know the home price continues to just rocket higher. So the fact that the asset side of the balance sheet for the average American, is doing quite well. They hold financial assets. That is why they are in the top 1% or the top 10%. Those people are doing quite well. We know that the delinquency rate, we know that the bottom half of America they don't have financial assets, they only have debt, and that debt has skyrocketed in terms of the cost of that debt or the interest rate on that debt. So, when you talk about the economy nowadays, it's important to differentiate between, the median and the mean, because the mean is buoyed by that top 1% that has never been better. The median, on the other hand, I think takes into account much more the real experience of the median, the real average American, and we know that they are struggling with higher interest rates. Now, remember, if we see a huge increase in supply of U.S. Treasuries, $1 trillion over the next 3 months alone, that is a massive increase in the supply of U.S. Treasuries. If demand just stays constant, you would expect that rates will move higher. Now, the bond market, I would imagine, has been pricing in the likelihood of the TGA being refilled. And so some of what we see in interest rates might be a significant degree of this TGA refilling already priced in. So we could see a bit of a buy the rumor, sell the news sort of event where yields actually decline because some amount of this kind of huge increase in debt issuance just to refill the TGA, some of that might be priced into yields already. So we could see a short-term decline in interest rates. But on the other hand, you have $1 trillion of bond supply being pushed onto the global bond market over just the next 3 months alone. So generally speaking, if you have a massive increase in supply, $1 trillion of U.S. bonds, and then demand is flat, you would expect rates to move higher. Again, talking about those delinquency rates, the average American does not care what the overnight interest rate is. They cannot borrow overnight. They do not have access to SOFR or the discount window. They don't have, the Fed paying them 4.4% on their checking account, right? This is overnight dollar markets. This is the financial system. But average Americans don't have access to this. It really doesn't matter too much to the average American. So therefore, what we could see is if rates move higher, that is restricting the real average American who, mortgage, credit card, auto loans, those are priced off the 30-year bond, off the 10-year bond, off the long end of the yield curve, not off of the short end of the yield curve, which is the overnight interest rate that the Fed controls. So the Fed can cut this overnight interest rate all they want, but it's not going to help long-term rates. This is one of the main issues I have with people like Pulte, is that they honestly, genuinely believe that if they cut this federal funds rate, this Fed rate, from 4.3 down to say 1, they honestly believe that that'll cause the 30-year bond yield to go down. But I think it's the exact opposite, which is the market overall understands that the U.S. economy, with unemployment at 4.1 and core CPI at 2.9, basically 3%, the bond market knows that we are doing okay. Again, overall, I understand that the bottom three quarters of America is not doing well, but overall, in the aggregate, as the U.S. Treasury said. And so therefore, I think bond yields at the long end of the yield curve would move higher on the recognition that the Fed is just, we're going back to this fiscal dominance regime where they are cutting interest rates for the sole purpose of financing the interest expense, financing the debt. That is fiscal dominance. And I think the bond market would not take too kindly to a rapid significant cut in the federal funds rate way beyond what is needed. Sure, 25, 50 basis points, is that reasonable given where the overall economy is? Sure, but 300 or 350 is not really needed. The unemployment's at, headline is at 4.1, core CPI is at 3% basically. So if they were to kind of go this fiscal dominance emerging market sort of playbook, cut the overnight interest rate, which doesn't affect the average American, and just finance even more debt in bills, which are much less volatile, much more easily levered into U.S. dollars for private dollar credit creation. Remember, private banks create dollars just as the Treasury or the Fed does. That could cause the yield curve to steepen, meaning short-term rates might be coming down, but again, that doesn't affect the average American. That would cause the yield curve to steepen as, say, the 10-year, the 20-year, the 30-year bond, which do influence Americans. Those could move even higher on inflation concerns, on fiscal dominance and fiscal concerns with the solvency and the ability to finance the debt for the U.S. government. I think that we would see a yield curve steepening, which again, that would actually tighten conditions for the average American. So by cutting the federal funds rate, by cutting the overnight interest rate more than is needed, they could actually make it worse. They could make that credit card interest rate higher. They could make that auto loan interest rate higher. They could make the mortgage rate go higher. This is a key thing that I don't think I think Scott Bessent, the U.S. Treasury Secretary, I think he understands it. He has to play to his boss, which is Donald Trump. But then you have other people like Kevin Hassett and Pulte and some of these people that seem to just really not understand how any of this works. And it could be quite dangerous to pull this emerging market playbook and issue all the debt in short-term bills, which is very pro-liquidity, and to basically run an emerging market playbook, fiscal dominance playbook, where the U.S. government is telling the world, yep, the only way we can finance ourselves, finance our interest, is by basically payday financing. 90% of our government's going to be funded on an overnight or 1 month basis. No one is willing willing to buy our debt for 10, 20, 30 years. We're just going to finance all of it in 1 month bills, 3 month bills. That's not a sign of strength. So again, that's a headwind to the dollar. But again, I think that it's tough to say which will win out. All these concerns, capital repatriation, kind of fiscal dominance. There's a number of negatives for the dollar. But as we were looking at with the TGA, if this is going to be refilled, we could see the dollar have, it could be bullish for the dollar on a short term basis. But again, those medium to long term headwinds still are there. So, anyways, hopefully that was helpful, and I will link those articles in the description and catch you in the next one.